Welcome to the deep dive. Today we're tackling a really interesting piece, Investment Thesis for MSTR.pdf by Chris Millis.
Yeah, and our goal here is really to get under the hood of this analysis, understand the core arguments. We want to see why strategy, you probably remember them as MicroStrategy,
Mm.
why they're being seen now as, well, something fundamentally different than just a software company.
Right, focusing on that very deliberate move into becoming a Bitcoin treasury company.
Exactly.
And this isn't just a quick opinion piece. Millis has done a pretty deep dive himself. He covers, the business, the team, financials, market context, risks.
The whole 9 yards, and importantly, the actual investment rationale behind this whole Bitcoin strategy.
It's quite comprehensive, and for anyone listening who really wants to get into the weeds with this,
Which we recommend. It's fascinating stuff.
absolutely. If you want to download the actual document, we've got you covered. There's a link in the description if you're watching this on YouTube.
And if you're listening over on X, check the comments, the link's there too.
Yeah, definitely worth a look. I think you're going to find this really interesting. We're talking about a public company doing something, well, pretty unique with Bitcoin. Might even change how you view corporate strategy a bit.
Definitely some surprising insights.
Okay, so let's get started. Where should we begin? Maybe the big picture. That core shift in strategy's identity.
Yeah, I think that's the place to start. The document makes it really clear. Strategy's in the middle of this major transformation.
Moving from being, the largest publicly traded BI software company?
Right, to becoming the largest publicly traded Bitcoin treasury company. And the key aim, according to Millis, is all about preserving and, crucially, growing shareholder value. Bitcoin is now the main tool for that.
It's almost like the original software business. Well, still running.
It's still there, yeah.
It's become the supporting act. The author even kind of suggests setting it aside for this analysis, which is a bold take.
It really is. It underlines just how much their future is tied to Bitcoin now. But understanding how they got here helps. Founded as MicroStrategy way back in '89.
Right, focused on business intelligence.
Built a name there, went public in '98, hit some turbulence around 2000, but they rebuilt, became a BI leader again.
And then 2020 happened.
Exactly. That big pivot, concerns about inflation, fiat devaluation. They decided Bitcoin was the primary treasury reserve asset.
And that wasn't just a small allocation, was it? It was a fundamental change.
Absolutely. It drove leadership changes, too. Michael Saylor, the longtime CEO, he moved to executive chairman to focus specifically on the Bitcoin strategy.
And Phong Le stepped up as CEO.
Right, to manage the BI side. So you see this split focus, even though this thesis really leans into the Bitcoin narrative.
Which brings us to the rebranding earlier this year, 2025. MicroStrategy to strategy. Seems symbolic.
It does. And Saylor laid out the reasons, according to the document. Simplicity, elegance.
Getting rid of micro.
Yeah, felt outdated, maybe. Strategy resonates globally. It's easier to say, spell, type,
Oh,
Just a stronger brand for what they are now.
makes sense. Aligning the label with the reality. The author brings in Occam's razor here too, right? Simplest explanation.
Yeah, and Sosnoff's law, which is kind of amusing. The thinner the research file, the less trouble and maybe more potential.
So the idea is this Bitcoin model is fundamentally simple.
At its core, yes. Use tap new markets, buy Bitcoin, hold Bitcoin, grow value. And it's telling that their industry classification now is listed as financial services.
Wow. Okay, that really says it all. So we have the business transformation. What about the narrative driving it? The document calls it a corporate monopoly on Bitcoin.
Yeah, pretty strong language. And it's a narrative very much shaped by Saylor. There's that quote in the doc. I want to own dominant technology monopolies that everybody needs, nobody understands, and are unstoppable.
That's ambitious.
Very. The author rates the narrative highly, though, 9 out of 10. Says it's clear, simple, credible, authentic, even emotional, and contagious.
A 9 out of 10. That's powerful. And it's coming from within, right? Not just marketing fluff. It's backed by their actions.
Precisely. They're actually doing it. And the business model, like we said, is simple. Leverage capital markets debt, equity buy Bitcoin, hold Bitcoin, leverage Bitcoin, grow shareholder value.
And the author poses that question. Why isn't everyone doing this?
Right. It highlights how unique their path seems. And maybe hints that people overestimate the short term, but underestimate the long game strategy might be playing.
So what gives them this edge? These competitive advantages, the moat the document talks about, it lists things like cult, first mover.
Yeah, those are the initial ones. But the more durable moat factors are things like brand equity, monopoly in this context, optionality, being visionary, and interestingly, volatility.
Volatility. How is that a moat? That seems like a risk.
Well, the idea is they can use the volatility, especially with things like convertible bonds, which we'll get to. It's about understanding something others don't, maybe. Like that Polari quote included finding truths others miss.
Okay. And this moat isn't static. It's widening.
That's the assessment, yeah. It's growing stronger.
And these flywheels that power it, the leveraging capital markets one, how does that work again?
It's a feedback loop, basically. Raise capital, buy Bitcoin. Bitcoin price potentially goes up. Strategy's market cap increases. Easier to raise more capital on better terms. Buy more Bitcoin.
Got it. A virtuous cycle, assuming Bitcoin appreciates long term. And the market indexes flywheel.
Similar idea, but driven by passive investing. Strategy gets included in indexes. Index funds have to buy the stock. Stock price goes up. Easier to raise capital, buy more Bitcoin. Market cap grows. Potentially bigger index weighting, more passive buying.
And the author says, strategy doesn't need indexes. Indexes need strategy.
Bold.
Very bold. It emphasizes their unique position.
Okay, let's dig into that monopoly idea more. Why does the author argue they have a monopoly in Bitcoin holdings, even if it's not a legal one? Several reasons laid out. One, few public companies have the scale or, frankly, the guts to use leverage like Strategy does to buy Bitcoin. Two, even if they did, do they have a sailor? Someone with that deep conviction and commitment.
Good point.
Three, ownership structure. Saylor has significant voting control. Most big companies would need broad consensus for such a radical shift. Four, the scale issue. If a competitor tried to buy as much Bitcoin, they'd likely drive the price up, benefiting Strategy as the biggest holder.
Right, the impact of their own buying.
Exactly. And finally, smaller companies can't play at this scale, and bigger, more diversified ones can't offer that pure Bitcoin exposure. Dylan LeClaire's quote sums it up. Strategy is the most compelling story in corporate finance.
It paints a picture of them being in a class of their own right now.
Oh.
Then the document dives into all these key mental models. Wow, there's a lot. Why look at it through so many different lenses?
It's about offering different frameworks, different analogies to really grasp what strategy is doing and what it could become. Ways to understand the different facets of their strategy. The three strategy premiums. Strategy is the standard oil of Bitcoin. Strategy is a Trojan horse. Lots of angles.
Let's unpack maybe just a few key ones. The three strategy premiums.
Yeah, this one's interesting. It connects three things. The Bitcoin premium, Bitcoin's price potentially rising. The equity premium, people paying more for MSTR because of the Bitcoin. And the convertible bond premium, investors accepting lower yields on bonds that can convert to that Bitcoin-linked stock.
And they feed each other.
That's the idea. A positive feedback loop driving value up.
Okay. What about strategy as a platform?
Think of it like a tech platform, but for finance. It attracts fiat, capital dollars, euros, whatever from investors and converts it into Bitcoin exposure. It's sort of building infrastructure for this digital capital transformation.
And strategy is the Amazon of fixed income. Big comparison.
Very ambitious. The analogy is just like Amazon became the go-to place for, everything, Strategy aims to be the dominant platform for Bitcoin-related financial products at massive scale.
How about strategy is the standard oil of Bitcoin?
That parallels how Standard Oil aggregated and standardized oil. Strategy is seen as doing something similar for Bitcoin as a financial asset, gathering it, packaging it in ways accessible to traditional finance.
And strategy is a Trojan horse. That sounds sneaky.
Huh. The idea is that by getting into major stock indexes, Strategy is kind of sneaking Bitcoin exposure into millions of portfolios, maybe even people who wouldn't consciously buy Bitcoin directly. Passive investors just get it as part of the index.
Okay, one more. The endgame model.
This points to the ultimate vision. The document mentions Saylor comparing their ambition to Saudi Aramco, aiming to eventually hold a really significant chunk, maybe 5%, 10%, 15% of all Bitcoin, like Aramco's dominance in oil.
Wow. These models really paint a picture of massive scale. Okay, switching gears. How do we measure their progress? The KPIs, key performance indicators.
Right. The document highlights 5 main ones. Total Bitcoin holdings, multiple of net asset value, or MNAV, Bitcoin yield, Bitcoin per share, and Bitcoin torque.
Okay, total Bitcoin holdings. Pretty straightforward.
Yeah, just the total amount of BTC they own.
Yeah.
And because they're public, it's audited, so it acts like a proof of reserve.
Got it. Multiple of net asset value, MNAV. How's that work?
You take their market cap, total stock value, and divide it by their net asset value. NAV here is basically the market value of their Bitcoin plus other assets minus liabilities. So MNAV shows if the market values the stock at a premium or discount to its underlying Bitcoin holdings.
Right. than Bitcoin yield. That's newer, right?
Yep.
Q2 2024.
Yeah. It measures the percentage growth in their Bitcoin holdings compared to the increase in their diluted shares outstanding. It basically shows how effectively they're growing their Bitcoin per share through what they call accretive dilution.
Meaning they're adding Bitcoin faster than they're issuing shares?
Ideally, yes, that's the goal of accretive dilution.
Okay. And Bitcoin per share.
Simple division. Total Bitcoin divided by diluted shares outstanding. The author notes diminishing returns here as they get bigger. Each new Bitcoin adds less to this number per share. They can boost it by buying Bitcoin when their stock trades at a premium to NAV, or buying back stock when it's at a discount.
Makes sense. Lastly, Bitcoin torque. Sounds powerful.
It aims to measure the return on the capital they've invested in Bitcoin. It's calculated as the dollar gain in their Bitcoin value plus any income, though there isn't direct income now, divided by the capital invested. Higher torque means better return on investment. Higher MNAV generally helps torque.
Great. These KPIs give you a good dashboard to watch. Now, what about competition? The document basically says there isn't any, at least not directly in this specific game.
Yeah, that's the core argument for their monopoly position. The scale, the leadership, the structure, it makes it incredibly hard for another public company to replicate what they're doing with the same focus and leverage. So in that niche of publicly traded Bitcoin treasury companies, they're kind of alone.
But interestingly, the author argues that new companies starting to hold Bitcoin might actually help strategy. How does that work?
It goes back to that capital markets flywheel. New buyers enter, demand for Bitcoin increases, Bitcoin price potentially goes up, Strategy's existing huge stack of Bitcoin becomes more valuable. Strategy's market cap rises, they can raise more capital more easily, buy even more Bitcoin.
So, new entrants fuel strategy's engine.
That's the idea. The author calls it achieving escape velocity. More corporate buyers actually reinforce Strategy's lead, paradoxically.
Fascinating dynamic. Okay, let's talk opportunities. The general feeling seems to be the upside is bigger than people think.
Absolutely. That quote, with foresight, strategy is inevitable, really captures the conviction. It circles back to the Bitcoin treasury focus, Saylor leveraging that digital capital base. Like the Victor Hugo quote also included, nothing is more powerful than an idea whose time has come.
And the idea of trying to time Bitcoin buys? The author says strategy shouldn't bother.
Yeah, basically a bad idea for them. Saylor probably has better asymmetric information. Trying to time it is risky. You could miss huge pumps. Investors apparently like their consistent, buy the top, forever approach. It builds trust. And Saylor's playing the long game, not trying to be a trader.
Simplicity is sophistication, as Da Vinci said.
Exactly.
So how does strategy stack up against other ways to get Bitcoin exposure, like just buying Bitcoin or an ETF?
The document lists a bunch of advantages for Strategy. Largest corporate holder, uses leverage, generates that Bitcoin yield, no direct fees like an ETF. It's an international gateway for some investors. Stock is liquid, deep options market, index inclusion potential.
And maybe even a future Bitcoin bank. Bitcoin with benefits?
Yeah, that's the playful term used. Though it's important to remember owning MSTR stock isn't the same as owning the actual Bitcoin.
Right. That's the raw versus wrapped idea, isn't it?
Exactly. Raw Bitcoin, BTC, is for self-sovereignty, saving. Wrapped exposure via MSTR is potentially for compounding wealth, more offensive, maybe higher ROI focus, different tools for different goals. That Bill Miller IV quote is strong. Owning strategy is better than owning a Bitcoin ETF.
And the core mechanism is leveraging the balance sheet, using depreciating fiat to buy appreciating Bitcoin.
That's the heart of the flywheel, using traditional finance tools to acquire this new digital asset. And because their main asset is Bitcoin, their direct exposure to fiat decay is relatively low. Like the author says, once you truly see what strategy is doing, you can't unsee it.
What are the main ways they raise that capital, the levers?
4 main ones listed: traditional debt, convertible debt, equity issuance, common or preferred stock, and at the market, ATM offering selling shares gradually. Saylor says they'll use whichever offers the best terms at the time. Flexible.
The document mentions their preferred stock, CSTRK. How does that fit in?
Right. CSTRK is perpetual preferred stock. Pays a fixed cash dividend, proceeds go to buy Bitcoin. It has redemption options for strategy. It sits higher than common stock in priority, but lower than debt. Crucially, the author notes their borrowing isn't really limited by the software business earnings because the debt lacks those restrictive covenants.
Let's talk more about convertible bonds, MSTY. They seem really key.
Definitely. Their hybrid instruments start as debt, pay a coupon, but can be converted into MSTR stock at a set price later if the stock goes up. Investors get potential equity upside with some debt downside protection. Pricing depends on interest rates, credit quality, stock price, and importantly, volatility.
Higher conversion price is better for existing shareholders, right?
Yeah.
Less dilution.
Generally, yes.
And what's convertible bond arbitrage? Does that explain why MSTR sometimes has high short interest?
It's a big part of it, likely. Arbitrageurs buy the convertible bond and short the stock simultaneously, playing the pricing differences and the option value, often betting on volatility. So yeah, a lot of the short interest is probably just these hedges, not people betting against the company fundamentally.
Why might strategy not issue convertible bonds sometimes, even if they want capital?
Could be a few things. There's usually a lockout period after an issuance. Market conditions matter hugely. Converts are most attractive for strategy when MSTR stock volatility is high.
High volatility is good for them here.
Yeah, counterintuitively. High volatility boosts the option value, letting them issue bonds with lower coupons and maybe higher conversion prices, less dilution. So if volatility is low, they might prefer issuing STRK preferred stock or using ATMs.
So upside volatility helps them how?
Bondholders convert, which cuts strategy's debt. Downside volatility. Maybe they can issue new bonds later at lower conversion prices, which might seem bad, but could be attractive if the stock recovers strongly. It lets them play the volatility game. The author says they're demonetizing the bond market.
Strong words again. And this appeals to bond investors desperate for yield.
That's the context. Low rates, inflation, traditional bonds aren't cutting it. Strategy's converts offer a path to potentially huge gains via Bitcoin exposure without holding BTC directly. It's the ultimate Bitcoin buffet, offering different risk-reward options. They might even issue zero or negative coupon bonds eventually, for investors purely focused on stock gains.
And only strategy can do this at scale with Bitcoin backing.
Because of their massive, audited Bitcoin holdings, no one else comes close in the public markets. Saylor's quote, nails it. We're the only company that can actually create bonds backed by Bitcoin. That's the big idea.
There's a point about insurance companies, too.
Yeah, investing in Strategy's converts might let them get Bitcoin exposure indirectly without facing the same regulatory capital issues they might if they held BTC directly on their balance sheet.
Strategy targets a low leverage ratio, around 25%. What's the effect of that?
It creates a sort of automatic trigger. When conversions lower their debt below that target, it gives them room and incentive to raise more debt, buy more Bitcoin, and get back up to around 25% leverage. It drives continuous accumulation.
We mentioned equity issuance. Preferred stock is less dilutive than common.
Generally, yes. Preferred stock, CCRK, pays a dividend but doesn't usually have voting rights and ranks below debt but above common equity. It's another tool to raise capital with potentially less impact on common shareholders per dollar raised compared to issuing more common stock.
And at the market offerings, ATMs.
Those let them sell common stock directly into the market over time. They can use these strategically, maybe when MNAV is high, to raise cash to pay down debt, deleverage, while still aiming for that overall 25% target leverage.
Crucially, all their debt is unencumbered, meaning the Bitcoin isn't collateral.
Correct. It's huge. It means no margin calls on the Bitcoin if the price drops. They can't be forced sellers of their BTC due to debt covenants. The document lists their options when converts mature unconverted, basically refinance, pay with cash, or issue stock.
Okay, repeating the key point. Largest corporate holder of Bitcoin.
Monopoly position, as the author frames it.
And the ambition.
Yeah.
Amazon of fixed income. Targeting 1% of the $300 trillion market.
It's a staggering goal, yeah. Capturing even a tiny fraction of that market via Bitcoin-linked products would be transformative.
Index inclusion, that flywheel seems powerful, driving passive flows.
Potentially very powerful. Automatic buying from index funds could significantly boost demand and price. That vampire attack, quote, captures the idea of siphoning capital, though the specific criteria for big indexes like the S&P 500 aren't detailed here.
What about bear market protection? Does this strategy shield them? The author seems doubtful.
Yeah, unlikely to be fully immune. Investor psychology, global liquidity, these are big forces.
Yeah.
MSTR and BTC show correlation with markets like the NASDAQ, NDX. High retail ownership could mean panic selling. Maybe long-term hyper-Bitcoinization changes that, but near-term, a big downturn would likely hit them too.
The idea of strategy becoming a Bitcoin bank Saylor seemed to push back on that recently.
He did, in a 2025 interview apparently. Said focus is on capital raises and Bitcoin yield, not monetizing the Bitcoin stack via banking services right now. But the potential remains, right? The document acknowledges that. Quotes from Hal Finney and Saylor himself from years ago discuss the rationale for Bitcoin banks.
And a strategy stablecoin, backed by their Bitcoin.
Another potential future path explored. An over-collateralized stablecoin using their BTC reserves could enable borrowing and generate fees, increase BTC demand. It'd be different from algorithmic or purely fiat-backed stablecoins. Could potentially get huge.
What would make a strategy stablecoin stand out?
Institutional-grade custody and transparency, being a public company, brand strength and trust, deep liquidity from their reserves allowing strong over-collateralization, maybe regulatory advantages operating in the U.S. framework, a real alternative to USDT USDC, not reliant on fiat backing.
But challenges exist. Regulation pegs stability.
Definitely. Regulatory hurdles are significant and evolving. Maintaining the peg against BTC volatility, even over-collateralized, is complex. Lynn Alden's quote highlights risks with decentralized stablecoins, and current stablecoin bill drafts might not easily accommodate a Bitcoin-backed model yet.
Okay, let's flip to the downsides. The risks. Author thinks they're generally overestimated.
That's the perspective, yeah. But the document does identify key ones.
What are the big three?
1, a Bitcoin extinction event, total network failure, game over if that happens. 2, a prolonged decline in Bitcoin price, could force equity issuance to repay maturing debt if they can't refinance. 3, loss of Bitcoin holdings, custody failure, hack, key loss, that would destroy the business model.
And other lower probability risks.
Things like volatility drying up, bad for converts, adverse regulation, counterparty risk on debt, maybe a theoretical order 6102 style seizure, very unlikely. Bitcoin becoming tax-free, changing incentives, keyman risk with Saylor.
Though the author argues against keyman risk being major.
Yeah, quotes Buffett, suggesting the strategy and team are strong enough. Also mentions systemic risk potentially growing as strategy itself gets bigger.
Okay, let's talk the team. Importance of liking, trusting partners, Munger on management quality. Who are the key people?
Primarily Michael Saylor, executive chairman, co-founder, long history, navigated crises, visionary, deep Bitcoin understanding, intense personality described, takes $1 salary, compared even to Satoshi.
And Fang Li.
President and CEO since August 22.
Oh.
Came up through MicroStrategy, key and cloud transition, and the Bitcoin strategy execution. Seen as the operational counterpart, maybe the Wozniak to Saylor's Jobs, as one analogy put it.
General takeaways on the team.
Founder-led, which often outperforms. Saylor seen as having key innovator traits. Driven internally, radically, long-term view. Lots of skin in the game via Saylor's 14% ownership. Acts in shareholder interests. Detail-oriented, innovative, rational, candid. Resists institutional pressures, incentives seem aligned, under-promise, over-deliver track record claimed.
What about the culture? Is it strong?
Yes, assessed as strong, which correlates with outperformance. Uses family language internally. There's that old anecdote from 2000 about Saylor tracking employee happiness, doing cruises, suggests a long-standing focus, maybe.
And they can attract talent.
Seems so, likely due to the potential equity upside tied to the Bitcoin strategy. Incentive structure uses cash bonuses tied to operations and equity awards vesting over time.
Moving to the numbers, mainly stock-based comp here.
Yeah, the document notes the philosophy isn't fully detailed, DBC, but confirms SBC is below 15% of revenue and no preferred stock on the balance sheet currently, aligning with the Buffett rule. Munger's quote acknowledges options are an expense, but also dilute.
Okay, the market section. Valuation, all models are wrong.
Yeah.
Strategy has no ceiling because the dollar has no floor. Sounds hard to value.
Exactly. Highlights the difficulty. Reaffirms high MNABV helps the Bitcoin yield strategy. Less dilution per BTC bought. Range of expected values is considered high. Quotes from Marx, Buffett, Klarman emphasize patience, being early. Share buybacks seen as less relevant now.
Risk asymmetry is favorable.
Yes, that's the view. Bill Miller, the fourth quote, supports this. Upside potential seen as much larger than downside risk. Opportunity cost is mentioned via Munger Buffett. Sora's quote on needing to be contrarian to outperform.
The other section sums up the thesis simplicity.
Yeah, boils it down to, will Bitcoin keep going up? And will strategy keep buying leveraging effectively? Elevator pitch. Monopoly on the biggest corporate stash of the hardest asset in the biggest asset class. Thesis seen as expanding, which is good. Probability of permanent capital loss estimated at 2%.
Then there's the author's personal take. High conviction.
Very high. Rates their own understanding 910, believes they have an edge because the market hasn't fully grasped Bitcoin's monetary shift or strategy's role, aligns with their philosophy, intuition resonates, independent thinking emphasized, calls it a must-own, not just nice to own, comfortable holding 10 plus years, within circle of competence.
Finally, those frequently amplified qualms, or FAQs, how are common criticisms addressed? Often points back to Saylor being the biggest shareholder.
That's a common refutation tactic used, yeah. Those incentives are aligned. Then specific points. Ponzi. No, it's leverage Bitcoin holding. Scam. No, capturing value, accelerating Bitcoin standard. Closed-end fund. No, leverage and other benefits beyond ETFs. Just buy Bitcoin. Different goals. Software is trash. Doesn't limit borrowing. Sailor selling. Pre-granted expiring options will get liquidated. Unsecured converts mean equitization, not likely forced Bitcoin selling.
Okay, wow. That was a comprehensive run through the thesis. So, to quickly recap, the core argument from Millis's analysis is that Strategy has carved out this unique spot as the top public Bitcoin treasury company. They're using capital markets very strategically to just accumulate Bitcoin, betting big on its long-term rise, creating this powerful flywheel with kind of no real direct competitors in their specific lane.
That sums it up well. It's positioned not just as a company holding Bitcoin, but potentially a really significant player reshaping finance as digital assets grow. And yeah, for anyone listening who wants the full detailed picture.
Don't forget that link.
Exactly. In the description on YouTube and the comments on X, you can download the whole PDF document Millis wrote.
Definitely worth checking out if this has piqued your interest.
Absolutely.
And that brings us to the end of this deep dive. It really makes you think, doesn't it? About the long-term game here, Strategy's bold bet, and this whole shift to digital assets. It leaves us with a question, maybe. What does the future of corporate treasury, of financial strategy itself, look like in a world where Bitcoin plays an increasingly central role? Something to chew on.
Definitely something to think about.
Thanks for joining us for this deep dive.